Today, we're going to break down the core principles from what might just be the most influential book on investing ever written, Benjamin Graham's The Intelligent Investor. And we're going to focus specifically on his powerful method of defensive investing.
And you don't have to take my word for it. This book has some serious street cred. Warren Buffett, who was one of Graham's most famous students, still calls this the best book on investing, period. For him, these weren't just lessons. They were literally the foundation for a lifetime of success. So let's see what they're all about.
You know, this quote gets right to the heart of Graham's philosophy. He believed that success in investing has way less to do with how smart you are and way more to do with your temperament. It's not about outsmarting the market, it's about mastering your own emotions. And honestly, that's the real challenge we're all facing.
All right, so here's our game plan. First, we're going to nail down the huge difference between being an investor and being a speculator. Then, we'll talk about how to build a defensive portfolio, set some really strict rules for picking stocks, and really get a handle on the most important concept of all, the margin of safety. And finally, we'll see how it all comes together.
Okay, first things first. Graham is adamant about this. You absolutely have to know whether you are investing or speculating. Seriously, they are worlds apart, and confusing the two is a total recipe for disaster. So, Graham makes the distinction crystal clear. An investment is like a business operation. It's based on deep analysis, and it aims for safety and a reasonable profit. Pretty much anything else, just betting on which way a stock price is going to move, that's speculation. Look, the gambling instinct is human, but you have to keep it on a tight leash and never, ever mistake it for real investing.
So how do you know if you're really investing? Well, Graham gave us this super handy 3-part test. Number 1, you've done a thorough analysis of the business. 2, you've made sure your principal, your initial money, is protected from serious loss. And 3, you're aiming for a satisfactory return, not necessarily a spectacular one. If your plan fails even one of these, you're speculating. Simple as that.
Now, to explain just how irrational the market can be, Graham came up with one of the most brilliant metaphors in all of finance, Mr. Market. So imagine you own a piece of a business, and your partner is this guy, Mr. Market. Every single day, he shows up, and he's just a mess of wild mood swings. He offers to either buy your shares or sell you his at some price. Some days he's totally euphoric and names a ridiculously high price. Other days he's in a complete panic and offers you a crazy low one. And here's the big takeaway from that little story. Mr. Market is there to serve you, not to guide you. You have zero obligation to trade with him. The intelligent investor just ignores his crazy happiness and takes full advantage of his pessimism, right? Buying low when he's scared. You are in control, not the market's mood.
Okay, so we've got the right mindset. How do we turn that into an actual practical strategy? Let's talk about building what Graham calls a defensive portfolio. Graham's core rule here is incredibly simple, but really powerful. A defensive investor should always have a mix of high-grade bonds for stability and quality stocks for growth. But he sets these clear boundaries. Your stock portion should never be less than 25% or more than 75% of your whole portfolio. For most people, he says, a 50-50 split is a great place to start. And you can see exactly how this rule works in practice. When the market gets dangerously high, when Mr. Market is euphoric, you should trim your stock holdings down toward that 25% minimum, taking profits and shifting into safer bonds. But on the flip side, when the market crashes and stocks are on sale, that's when you ramp up your stock holdings toward that 75% maximum. It's a mechanical rule that forces you to buy low and sell high, and it's your best defense against your own emotions. Okay, so we've got our asset allocation figured out, but which stocks do we actually buy for that part of the portfolio? Well, for this, Graham gives us a very strict, very actionable checklist. These are basically Graham's rules for playing it safe. He says to stick to large, well-known companies because they offer more stability. They absolutely have to be financially strong enough to get through tough times. A long history of making money and paying dividends proves they're resilient. And this is the big one. Even if it's a fantastic company, you must never overpay for it. So how do you actually test that financial strength? Graham focuses on tangible assets. We're talking the real stuff like cash, buildings, and inventory, not fuzzy things like brand value. And his rules are tough. A company's short-term assets should be at least double what it owes in the short term, and its long-term debt shouldn't be more than the cash it has left over for day-to-day operations. These tests make sure you're buying a business that is truly solid. All right, now we get to it.
the cornerstone of Graham's entire philosophy. Seriously, if you remember only one thing from our time here today, make it this: the margin of safety. So, what is this margin of safety? It's the secret sauce of sound investing. It's simply the buffer between the price you pay for something and what it's actually worth. This cushion is what protects you when, and it's always when, not if, your analysis isn't perfect or things just don't go according to plan. Let's make this super simple. You do your homework and you figure out a business is worth about $1 per share. But you don't buy it at $1. Nope. You wait until Mr. Market is having a full-blown panic attack and is willing to sell it to you for 60 cents. That 40-cent difference, that's your margin of safety. It gives you a ton of room for error and a really high probability of making a profit. And this is why it is so incredibly powerful. You don't need a crystal ball. You don't have to perfectly predict the future. If your margin of safety is big enough, you can be confident that even if things go a little wrong, you're protected from a major loss. It is the central concept of investing. So let's wrap this all up. What are the key lessons we really need to absorb to become truly intelligent, defensive investors? It really just boils down to these three things. First, get your emotions in check. Don't let Mr. Market's mood swings run your financial life. Second, use a disciplined system, like the ones we talked about, for how you allocate your money and pick your stocks. And third, always, always, always demand a margin of safety. That's how you protect yourself and set yourself up for long-term success. And that brings us to a final question, something for you to think about. See, the intelligent investor thinks for themselves. Your success isn't going to come from following the herd. It's going to come from your own sound analysis and your own emotional discipline. So you have to ask yourself, are you letting reason guide your decisions, or are you just following the crowd? That's the difference between investing and just gambling.